Let's start with what we're seeing in energy markets, because are you sensing that with Brent at 114, sure, WTI looks fairly restrained, but Brent at 114, gas prices jumping 24% in just this morning. Are you sensing that we're about to take a step change into new territory in terms of people's expectations, assumptions about how elevated energy prices are over the first and second quarter of this year?
I think that's absolutely what's playing out right now, Anna. And I think the way this is kind of transpiring is probably the trajectory for the next couple of weeks, in terms of that we'll go through periods of trying to be in denial or being optimistic and then have step shifts lower until we have clarity about the strait being, sustainably opened. And I just don't see how that clarity comes anytime soon. So I think what people are really starting to get, suddenly get kind of grasp, is that the impact on some of the derivative oil products, whether it's other commodities or whether it's natural gas or whether it's, things like helium and fertilizer, or whether it's jet fuel or shipping fuel, they're realizing that, there's a lot of industries that are going to be particularly badly targeted. What we're seeing in oil markets today is quite extraordinary, because WTI, when I walked down to the studio, was pretty much flat for the day, and yet we're seeing Brent really surge higher. So that spread is absolutely blowing out at the moment, and I think it's really problematic for specific economies, specific sectors, apart from the broader wealth destruction we're seeing.
Mark, what did you make of how Jay Powell responded to this conflict, the inflationary impacts, and how it kind of feeds into the Fed's thinking? What was the key line that stood out to you from yesterday?
I think the two big takeaways were that two of the previous dissenters no longer dissented, which made sense, so slightly hawkish the margin. And Powell saying he'd stay till the investigation is over, not guiding on longer. But the idea is that he might be around for quite a while. So, the Fed could never say anything useful about the conflict, because no one really has a clue on the trajectory. And we don't, therefore, if it ends, if in the optimistic scenario, which I don't believe, that it ends imminently and oil prices collapse, well, then they can kind of ignore all this shock. But, as it goes further, we have a stagflationary impulse. We do have both inflation and demand destruction, and which matters more will depend on the extent of that energy surge and how long it lasts. So for me, it was the other points to take away. It was a marginally hawkish meeting, but, it's completely overshadowed by what's happening in the Middle East.
And what are you watching for the rest of the day, Mark? Because there is a lot going on, certainly in terms of central bank decisions, but and headline risk around the Middle East, of course, is on our list.
Yeah, we have a load of central banks, and, a short-term watching out for the guidance of how they all speak about this. But we know, again, that like the Fed, there's not much they can do yet. This is a major problem brewing from them, but which way they're going to react will depend on the duration, which just sounds like such an annoying phase because it's so overused at the moment. It depends on the duration of the conflict. So I think the central banks won't really matter. I'm interested in the price action, and do equities start pricing in more of the damage that's caused from energy markets and related commodity markets? Because I still think there's a lot more downside in equity markets, despite it already being the worst month for global stocks in 3.5 years, as we talked about before.